Imagine producing 10% more of a highly sought-after commodity, but you're purposely leaving, like, over $18 a pound on the table.
Yeah, which sounds completely counterintuitive.
Right. It makes no sense. But that is the glaring reality right now for the world's largest uranium producer, Kazatomprom. Welcome to this deep dive. Today, we are looking at the August 16th, 2026 edition of the Uranium Unleashed Week Ahead newsletter.
And our objective here is basically to figure out if the data we're getting this week validates the whole supply discipline narrative or if it just completely destroys it.
Exactly. We're going to break down what this means for you, the listener, whether you're tracking physical trusts, producers, or just the broader energy transition. So, okay, let's unpack this.
Let's do it.
On Thursday, Kazatomprom reports their half-year financials, and the market is laser-focused on this massive gap. They got paid $67.88 a pound in the first half of the year.
Right, but the spot price is, what, sitting around $86.50?
Yeah, roughly $86.50. So there's this massive gap. I like to think of Kazatomprom like a landlord who owns this, huge apartment building.
Okay, I like this.
A few years ago, they locked tenants into 10-year leases at $1,000 a month. But today, the neighborhood rent has skyrocketed to like $1,500.
Yeah, so they see those new prices, but their actual cash in hand is stuck in the past.
Exactly. But here is where I'm confused. If they are acting with quote-unquote supply discipline, why did their August 3rd operational update show they produced 10% more uranium?
Oh, like 18 million pounds, yeah.
Right. Over 18 million pounds in the first half of this year. If you're stuck in bad leases, you don't go build a new wing on the apartment building. So why isn't the market panicking about oversupply?
Well, to understand why they aren't panicking, you really have to look at the mechanics of uranium contracting. I mean, it's not a pure spot market where you just dig up a pound today and sell it at today's ticker price.
So it's not like trading a stock.
No, not at all. When Kazatomprom reports a 10% production bump, that isn't uncontracted excess material being blindly dumped on the market to chase a quick buck.
Oh, so it's already spoken for.
Exactly. That volume is largely being pulled out of the ground just to fulfill those existing older contracts, those legacy leases from your example.
So they're legally obligated to produce that 10% bump just to meet the old schedules.
Precisely. The supply discipline thesis, the whole idea holding the market together, argues that because they're getting paid so far below the current spot price, they have zero financial incentive to flood the market with uncontracted volume.
Because doing that would just crash the spot price.
Right. And they desperately need that spot price to climb. They want to let those old, cheap legacy contracts roll off, expire, and then replace them at today's rates.
Got it. So Thursday's earnings call is kind of the ultimate stress test for this.
Yeah, we need to see if that realized price of $67.88 is finally creeping up to close the gap with the $86 spot average.
So we want to see if they're finally signing new leases at the higher rent. But, the newsletter outlines two other metrics for Thursday that dictate whether that production volume becomes a threat.
Yeah, and the first one is unit production cost. We have to know how much margin they're actually capturing.
Right, because if you sell at $67, but your costs like labor and supply chain inflation push your mining costs up to, $40 or $50.
Your margin is getting heavily squeezed. And knowing their true margin tells us exactly how high the realized price needs to go before they're actually incentivized to greenlight new expansion projects.
Makes total sense.
Yeah.
And the other critical metric was their second half outlook, specifically regarding physical constraints.
Yeah, things like the sulfuric acid supply bottlenecks. We've seen those plague the region for a while.
Wait, acid? Why do they need acid?
So in Kazakhstan, uranium is extracted by pumping vast amounts of sulfuric acid underground to dissolve the mineral. It's called in situ recovery.
Oh, wow.
So if there's a shortage of acid or if there are, logistical hurdles moving materials across the Russian rail network, their production is physically capped. It doesn't even matter what management wants to do.
So what does this all mean for the Thursday call? Give us the clear bull and bear scenarios here.
Sure. So a bullish outcome on Thursday would be the realized price gap narrowing, proving those legacy contracts are actually rolling off.
Right.
And then combining that with management citing second half constraints like a lack of acid, because that proves they cannot and will not push excess volume.
It shows they're physically constrained and financially motivated to let prices rise.
Exactly. Now, the bear case is pretty simple. If realized pricing is still deeply discounted and management declares they have plenty of acid and clear logistics for the rest of the year.
Then they might just flood the market.
Yeah. If they're willing and able to push volume while getting paid far below spot, it suggests the current supply side might actually challenge this whole high price narrative.
Well, while Kazatomprom tries to wait out the market on the seller's side, we need to look at the buyers, because the demand side of this equation is currently locked in a room together in Marco Island, Florida.
Ah, yes, the Utility Working Conference.
Right. Monday through Wednesday is the American Nuclear Society's Utility Working Conference. It brings U.S. reactor operators, fuel managers, and producers all to the same resort. But the sources explicitly say there are no press releases coming from this.
None at all.
So if it's just a closed-door networking event, why should we even care?
Because it forces the people who need uranium to keep the lights on into the exact same room as the people who pull it out of the ground. And the pressure in that room is at a boiling point right now.
Because of the deficit.
Yeah. There are three massive catalysts squeezing these utility managers. First is just pure arithmetic. The U.S. EIA recently confirmed there are 186 million pounds of uncovered U.S. utility needs through 2035.
186 million. That's a massive deficit hanging over the grid.
It's a staggering vulnerability. I mean, these are plants that absolutely need fuel, and they just haven't bought it yet.
Wow. And the second catalyst?
The cost of fixing that deficit, the term price, which is the benchmark for long-term contracts, just hit $94 a pound.
Which is an 18-year high.
Right, exactly. So these buyers are sitting there needing massive amounts of fuel and watching the replacement cost climb higher every single month.
That has to be terrifying if you're a fuel manager.
Oh, absolutely. And the third catalyst is the enrichment clock. The U.S. banned Russian enriched uranium, but there's a temporary waiver system in place so the grid doesn't just fail immediately.
Right, the waiver exception. And that expires in exactly 17 months.
17 months. Once that expires, the bottleneck isn't just getting the raw uranium, it's getting it enriched and fabricated into usable fuel without relying on Russia.
So utility managers have historically just dragged their feet, right?
Yes.
Hoping prices would dip.
Yeah, but sitting at a resort in Florida, staring across the table at producers, knowing you have a massive deficit, an 18-year high in term prices, and your key enrichment supplier is about to be legally cut off.
The case for delaying just completely disintegrates.
Exactly.
But if there are no announcements during the conference itself, what's the actionable takeaway for the listener?
Watch the corporate wire in the 2 to 3 business days after the conference closes on Wednesday.
Oh, because the conference is just the input.
Right, the sideline negotiations happen there. The output will be press releases from producers announcing new long-term agreements. If a producer drops a press release next Thursday about successful customer discussions, that handshake probably happened over a coffee in Marco Island.
Makes sense. Now, if the term market, those long-term contracts, is roaring at $94, we need to look at what's happening right now in the immediate spot market.
Yeah, the physical metal.
Right. TradeTech publishes their weekly spot price indicator on Fridays. And the newsletter points out that spot has been virtually frozen, just flatlining around $86.50 since February.
Yeah, it's been a really long plateau.
But the August 14th print showed a slight tick up to $87.45. Is a $1 move really that big of a deal?
It's less about the dollar amount and more about, well, breaking a psychological suffocation.
What do you mean by that?
For 4 months, the market has been completely paralyzed by this flat narrative. When a price just consolidates for a third of a year, buyers get complacent. They assume, oh, I don't need to buy today because the price will be exactly the same tomorrow.
So a tick up breaks that assumption.
Exactly. If this Friday's print holds above $87, it shatters that psychology. It proves the flat line is over and establishes a new, higher level of support.
It forces buyers to realize the floor has fundamentally shifted beneath them.
Right. But if it retreats back down, then the massive $7.50 divergence between the term price and the spot market just widens further.
And it's hard to sustain 18-year highs in term contracts if the spot market is weak.
Exactly.
Well, speaking of physical strength, this high-price environment is triggering tangible action here in the U.S. The newsletter highlights Energy in Wyoming. They just got final state authorization for their Shirley Basin project.
Yeah, and their first shipment of uranium-loaded resin to their Lost Creek facility is imminent.
Which makes them the largest U.S. ISR producer with 2 active extraction platforms running simultaneously.
Yeah, and having 2 active platforms provides unprecedented elasticity for the domestic market. I mean, we talk a lot about the political push for secure domestic supply chains, Section 232, ensuring we aren't reliant on foreign adversaries.
Right.
Every time a domestic producer actually scales up and pulls physical pounds out of the ground, it converts that whole political narrative into a physical reality.
It proves we can actually respond to this utility demand domestically.
Exactly.
But hang on. While U.S. producers are trying to scale up, sovereign nations are actively trying to pull physical fuel off the board entirely.
Yeah, this is where it gets wild.
The newsletter details India's state-owned power company, NPPC, putting out a tender for an overseas mine acquisition. They rely on imports for, like, 70% of their uranium.
Yeah, and the bids closed in July, so we're in the middle of the 4 to 8 week shortlist window right now.
So if India successfully buys a producing asset outright, say, in Canada or Australia or Kazakhstan, what happens?
That supply just vanishes from the commercial market. It completely bypasses the spot market and goes straight into India's strategic reserves.
So it's no longer available for those Western utility managers down in Marco Island.
Exactly. They are forced to compete for an even smaller slice of the global pie. It's the ultimate trump card. A commercial utility can offer a high price per pound, but a nation-state can just buy the entire mountain.
That is insane. And if India succeeds, what stops other sovereign wealth funds from doing the exact same thing?
Nothing. In fact, it provides a blueprint. If India proves a sovereign buyer can easily acquire and ring-fence Tier 1 Western assets, you could see an immediate acceleration from China or Middle Eastern nations building out their own nuclear fleets.
They just buy the board rather than play the game.
Exactly.
And that supply shrinkage isn't just happening through acquisitions. It's happening through international legal warfare, too. Look at Niger.
Oh, the situation at the airport.
Yeah. There's a stockpile of about 300 tons of uranium sitting at the Niamey airport. Romania's state nuclear company made a preliminary $40 million agreement to buy it. But Orano, the French nuclear giant, is threatening legal action against anyone who touches it.
Right. Because of Niger's recent nationalization moves, Orano is claiming rights to wet material.
So this is a legal powder keg. If Romania and Niger announce a binding contract this week, what does Orano do?
They'll likely pursue international arbitration. And they won't just sue Niger. They'll threaten the buyers, the transport companies, the intermediaries, anyone involved in moving it.
So by threatening litigation, they essentially redline the entire Sahel region for Western buyers.
Exactly. It makes the material legally radioactive. No commercial transport company wants to take on the liability of moving contested material. So even though that 300 tons physically exists, it is effectively frozen off the accessible market.
Again, the accessible pie shrinks. Which actually brings up another geopolitical choke point mentioned in the newsletter, the Strait of Hormuz.
Yeah, the active gray zone proxy conflict between the U.S. and Iran.
Right. The ceasefire is dead, the U.S. naval blockade is back, but Oman is actively brokering navigation talks. Now, I'm looking at this, and wet uranium doesn't even ship through the Strait of Hormuz.
No, it doesn't.
It comes from Canada, Kazakhstan, Australia. So why are uranium traders suddenly tracking Iranian naval movements?
What's fascinating here is the energy security premium. You're right, a blockade in the Strait of Hormuz doesn't directly disrupt uranium shipping, but a massive percentage of the world's oil and liquid natural gas flows through that choke point.
So when the strait is threatened, global fossil fuels are instantly vulnerable to price spikes.
Exactly. And when natural gas and oil look fragile, the policy argument for nuclear baseload power becomes undeniable.
Because a nuclear reactor only needs to be refueled every 18 to 24 months.
Right, and the supply chains are geographically diverse. You don't have to worry about a naval blockade in the Middle East shutting down your power grid next week.
That makes total sense. We're looking at this purely through a market lens. If Oman successfully brokers a deal, that geopolitical tension softens, and that energy security premium unwinds a bit.
But if talks break down, the vulnerability of fossil fuels dominates the front pages, and that just accelerates the policy urgency and the capital flow into nuclear power.
Wow. Okay, so we've got sovereign nations buying up physical fuel, utilities locked in a price war for what's left. That leaves one massive piece of the puzzle.
Yeah.
The companies that physically build and service the reactors.
Yeah, the wild card of the week.
Here's where it gets really interesting. Westinghouse, which is owned 49% by Cameco and 51% by Brookfield, filed a confidential S-1 with the SEC on July 31st.
And with the standard 30-day review window, a public IPO filing could drop literally this week.
We are talking about a nuclear services giant with over $9 billion in revenue and an $80 billion U.S. government strategic partnership pipeline.
It's massive, but its immediate market impact really lies in how it re-rates Cameco's stock.
Because Cameco has traded at a persistent discount to its consensus price target, right? It's supposed to be around 110 Canadian dollars.
Yeah, and a primary reason for that discount is the opacity of the Westinghouse asset. Because it's been private hidden inside this larger corporate structure, analysts just haven't been able to accurately value the nuclear services side of Cameco's business.
It's impossible to assign a proper multiple when half of the underlying math is locked in a black box.
Exactly, but an S-1 filing changes that overnight. It exposes the financials, the margins, the debt structure, all of it. If that document goes public this week, analysts can look at the data and definitively say Westinghouse is worth X billion dollars.
And since Cameco owns 49%, they plug that new number in. It removes the uncertainty, and it could trigger an immediate upward re-rating of Cameco's stock.
Right, towards that consensus target.
So, to bring this all together, we have utility buyers facing an arithmetic nightmare in Marco Island. We have the world's biggest seller opening their books on Thursday to prove they aren't dumping excess volume. The spot price is teasing a breakout. Sovereign nations are trying to buy mines outright. And a potential IPO filing could instantly reevaluate a legacy titan of the sector.
I mean, for months, the uranium market has coasted on compelling narratives. Supply discipline, the enrichment deadline, domestic elasticity. This week is the collision point.
We finally find out if the cold, hard financial data justifies the 18-year highs in term contracts.
The structural thesis is completely intact, but Thursday is the ultimate stress test. It all comes back to your apartment building analogy. You can talk all day about how much your building is worth because the neighborhood is gentrifying.
But eventually you have to prove someone is willing to sign a lease and write you a check for that higher amount.
Exactly.
Which leaves me with one final thought for you to mull over. We discussed India looking to buy a foreign uranium mine outright to guarantee their supply.
Right.
If a sovereign powerhouse like India looks at the global landscape and decides it is safer and more prudent to just buy an entire mountain of uranium outright, what does that say about the ultimate fate of the commercial utility manager, sitting at a networking conference in Florida, still waiting for prices to dip before they sign a contract?
It suggests the window for complacency has already closed.
And we might just get the first hints of the fallout this week. Thanks for joining us on this deep dive. Keep your eyes on the data.